Welcome to our market update for June. There's a lot of great things going on. You guys are really going to want to pay attention to this one. Monday morning, I had a really wild experience having lunch with Bruce Flatt. And if you don't know who Bruce Flatt is, he's the CEO of Brookfield Asset Management. Okay, the largest, one of, if not the largest asset management company in the world. And these guys manage close to $1 trillion worth of assets. Okay, real estate, infrastructure, pipelines, telecommunications, you name it. They're in it. So their macro lens of the economy and what's happening out there is unparalleled. So I had the pleasure and honor of hearing kind of a market update or an economic update, big picture update is what they called it. And then I got the opportunity to go for lunch with this inspiring gentleman and learned a lot that we can apply to our real estate investments and our real estate strategies as we embark on this latter half of 2024. So let's get right into it. One of the big things from a real estate perspective, it's being talked about inventory, okay? Inventory. So you can see the number of new listings in the Toronto area. Generally speaking, we see a lot of listings come onto the market seasonally, okay? Pre-spring market, we see listings hitting the market and they get absorbed quite quickly throughout May, June, July. This is historically. Now, all these numbers, all these colors on this graph, this is in a post-COVID environment. So what we tend to see is a little more alignment with the interest rate announcements, a little more alignment with the economic indicators versus the seasonality. But this graph clearly shows that seasonality is still a factor, okay? Early spring market and of course that September, October timing after the summer, back to routine, we tend to see an uptick in activity, an uptick in turnover, if you will, okay? So all things considered, our pace, we're outpacing last year in terms of inventory. We have a little more inventory than anyone would like. The absorption is happening just a little bit slower. Okay, the absorption is happening just a little bit slower. And what that means is it takes a new approach, a fresh approach to get these homes sold, to get this inventory actually moved. We have to be aggressive in our pricing, not underpriced, but aggressive and realistic in our pricing. There's not a lot of room to overprice, to negotiate. And the other thing is just the strategies that are deployed to get the homes sold. There's certain things we have to be doing now that enhance or embellish or more effort. The simplest way to put it is more effort and a more specific, more tailored approach. Okay, there's movement like we've never seen in the GTA. We've got people moving from St. Catharines to Oshawa, Oshawa to Barrie, Barrie to Richmond Hill to downtown core, downtown core to Brantford, Brantford to Collingwood. We're seeing some wild movement. So it's never been more important than right now to have exposure, maximum exposure for your listings. I'm very confident that this inventory will get absorbed as we move forward, and some of the reasons are right here on the next slide. So I'll move myself down here. Interest rate cut effect. I'm hearing a lot of people, a lot of agents, it's not that big a deal, right? Quarter point, who cares? In terms of the actual impact on purchasing power, the immediate impact on interest savings, it's not much, okay? On average, works out to about $20 for every $100,000 worth of debt. Every $100,000 worth of mortgage, you're saving about $20 with this quarter point cut. Is that a big deal? Not really. But what is a big deal is the mental piece of this pie, the narrative shifting, the Bank of Canada reinforcing that narrative, that confidence that the worst is behind us and we're headed in the right direction, okay? Lower rates also will not contribute to a construction boom. There are way too many factors at play in terms of the supply side, where I think supply is going to lag. The right word to be would be lag. The COVID effects, if you're on the highway and you touch your brakes, the 10th car stops, and for that to start moving again takes some time. Same idea on the supply side. We stopped completely for a while. For that train to start moving again, for those cogs to start moving, for that machine to start actively creating inventory, there's a lag. It's going to take some time. So the consensus now is about 2 to 4 years. Where do we stand on that? I think we're closer to the 2-year mark, aggressively, right? We've had a little bit of economic stability for the last 18 months, or stagnation, we'll call it. And what I think is going to happen is I think that we're going to see transaction volume tick upwards simply because of confidence. People still have to move. People still need to make things happen, okay, in their lives. It's not all investment. It's not all making decisions based on the market, based on the economy. Life happens. But from a construction standpoint, from a building standpoint, there's way too many factors impacting supply that make it difficult. Okay. Development charges have just gone through the roof. Development taxes, so the government charging taxes to the developers to build units that then gets passed on to the buyers. Those are the highest they've ever been in recent history. They just doubled late last year. Doubled, which is a big factor. The risk tolerance for developers, or let's call it the risk profile for their returns. On average, developers are making like maybe 6 to 10%, depending on the scale of the project. They're making 6 to 10% return for assuming all that risk, all the uncertainty with hard costs, soft costs, land costs, interest rate costs, of course, to carry the land and finance the construction. And then you've got the government imposing these taxes that make it extremely difficult for developers to build, earn a profit, and sell these units at a price that makes sense for the market. So we're going to see a big lag in new supply. And what that's going to do is insulate existing inventory and make this prime time real estate, this AAA real estate, this new sexy stuff that much more valuable. One of the points from Bruce Flatt at the Brookfield lunch was that I'll speak to office vacancy, right? We hear in the news office vacancy, office vacancy, office vacancy. And these guys, one of the big things that makes them successful is they're always learning, they're always hunting, they're always dissecting and trying to get the most access to information. So a simple example, office vacancy, yes, it's up, it's high. When you really break it down, you find that 90% of the vacancies, 90% are contained to 30% of the assets. That's the B's and C's, the undesirable office space, the old and aging office space. In a booming market, even that stuff is attractive. In a booming market, I talk to a lot of you that live on busy corner lots, that back onto highways, that have hydro lines in your backyard, the things that are typically difficult to sell with. Your window was COVID, man. Your window was COVID. Some of you did, some of you didn't. That's okay. But that was your window where those factors were less applicable. And for the office space example, same idea. We had the lowest office vacancy, Vancouver and Toronto had the lowest office vacancy in all of North America for the last 11 years pre-COVID. Okay, we still do. We're still, actually, Vancouver's the lowest. We're second lowest in the North Americas, which is incredible relative to the rest of the marketplace. But the point is, the AAA office space in the best locations, with the best amenities, with the newest, greatest innovation in building tech, they are 95 in commercial real estate. You'd call them fully occupied. They're fully occupied. So all this talk about office vacancy, are people going back to the office? In Europe and Asia, they've been back to the office. North American markets are lagging a little bit as a whole. But it's the AAA space that's getting the attraction in the tougher markets. And for you guys, buyers, sellers, investors, whatever it is, this is something you really want to pay attention to, because in a balanced market, it's going to be the new sexy stuff with the latest and greatest innovation that's really going to push the limits, that's really going to generate that attention, that attraction, and that higher price point. So don't mistake cheap for value, especially in this market. When we're sending you guys pre-con stuff, when we're promoting some investment opportunities, we don't want to mistake cheap for value. I could sell you some really cheap real estate relative to the market. It's not valuable. It's not going to be valuable. And relative for its market, it's probably still pretty high. Okay, there's some townhomes in St. Catharines. I wouldn't touch them right now in this market. There's some stuff coming in Brantford, Creemore. These are not sustainable markets. There's not a reason to believe in their growth. But relative to our market, downtown Toronto, 1,800 a square foot. I could buy these for $600 a square foot. That's a no-brainer, right, Ty? Well, no, because you're in Creemore with no business, no economic growth, no reason to believe in growth, no desire for people to live there. Rental profile stinks. And capital appreciation side, there's absolutely no reason other than overall market dynamics, which you could severely exceed anywhere else. So, long story short, I'm on the interest rate cut slide. The big thing for me on interest rates is, hey, here we are. This sets the tone. What's going to happen now? What's going to happen next? Well, we can confidently anticipate 1, maybe 2 more rate cuts in the latter half of the year, assuming everything still goes according to plan, right? Inflation's hovering around the mid-2s, which is great. And I've said it before, it's important to note again, Canada is one of the only developed countries that includes mortgage interest and rental inflation in our inflation numbers, in our core inflation numbers, which is wild. If you remove that from the bucket, we are right at the Bank of Canada's target. So I think when you factor that into play and you factor in some of the geopolitical things happening right now affecting the price of oil that has nothing to do with our COVID recovery and inflation running rapid, we can see the light at the end of the tunnel. So for me, this is that generational opportunity that we're unlikely to see again in our lifetime. Something this appealing, a market this attractive, to be moving up in asset class, to be getting in for first-time buyers, to be investing, deploying your capital. The upside potential is immense, and the fundamentals are rock solid. This was another thing that Bruce Flatt was really harping on and really confident in, is that the fundamentals of our market are rock solid. Right? Sure, there's wishy-washy things that happen, but real estate's a long-term play. Investing is a long-term play. If the two things he kept mentioning is if we can be patient and we can be disciplined, there is a ton of money to be made. They are deploying a ton of capital right now in valuable assets. That's why we're so aggressive on the good stuff right now, the new pre-construction, the new stuff that's going to be insulated because of the lack of addition of supply and those fundamentals in terms of population growth. First half of 2024, I don't know if I have this slide, this stat on here. I just read it this morning. First half of 2024, we brought in 260,000 people to Canada. If that doesn't wow you, then I don't know what else to tell you. Okay? Because that to me is incredible. And if only 1%, let's go absolutely crazy, let's say 1% of those people are coming to Toronto, to the GTA, to the downtown core. That's 2,600 people. Do you know how many units of housing we added last year? 1,700. So we are still at the lowest of the lowest of the lowest, most conservative projections. We're still not keeping up with demand. We are transitioning into that Singapore, London, New York style market where ownership is not going to be a realistic thing. Okay, it's going to be a renter market, and if you can get in now and lock something in, betting on the future of Toronto as a whole, you're laughing. And that's what's so cool, is that when you're investing in real estate in Toronto, there's so many factors impacting and insulating your investment that you can feel really good about it. You're not buying one stock that's dependent on one CEO that if he loses his mind or she loses her mind, that stock crumbles. Real estate's got so many positive, influential fundamentals: population growth, employment opportunities, lack of developable land, rent control, stable political environment, stable economic environment. Okay, we've got certain factors that to me make us so attractive, and the outlook with this rate cut, back to the rate cut, this shift in narrative, shift in mentality is we're gonna see an uptick in activity because now people want to take action. So back to that last slide, this inventory slide, we're gonna see some of this stuff start to get absorbed. Okay, meaning sold. Let's move on. The opportunity, I talked to you a lot about it there on the last slide. We've been sluggish. We know this. It's no surprise that we've seen stagnation in the market, I will call it. Okay, we've seen some stagnation here. But the big thing for me is that we are on the precipice. We are on the tip of the shift of change, meaning that the worst is behind us. We're no longer at the bottom of the mountain looking up or wondering about this uncertainty. Where are we? What's going to happen? When are rates going to start to cut? What happens next? We are now in a position where we can confidently, very confidently, predict some confidence in the market. With confidence comes predictability. With predictability comes opportunity. And when we have this opportunity, it's crazy not to take advantage of it. It really is. So is there opportunity in the market? There's sensational opportunity in the market right now when we pay attention to those fundamental factors that we know, that we're confident have an impact on our real estate pricing. So with that being said, let's move on to the CMHC market outlook. I feel free to pause it here and have a look at this, okay? So we've definitely seen a decline in housing starts, okay? That is, I spoke about it on a previous slide, partially due to the increase in financing costs, right? There's taxes, there's soft costs, there's employment, I guess lack of available labor in the labor markets right now, skilled labor. But the big thing with these higher financing costs, the higher cost of money, the more complicated, the more difficult it is for developers to take on these large scale projects with 7 to 8 to sometimes 10-year reversion periods, right? It's extremely difficult. And then In terms of increase in price, I mean, I think that the popular consensus right now is that prices will increase. Conservative estimates are around the 4 or 5%. More aggressive estimates, I'm hearing 6 to 7%. I am very confident that in the 2025, 2026 calendar years, we will get back to the 5, 6% that our market is accustomed to. I mean, our 40-year moving average is about 7% return on asset value. When you add in leverage to those calculations, holy smokes, there's opportunity to be earning well into the 20s and even 30% returns. The big thing for me is just paying attention to the fundamentals and understanding that the fundamentals are rock solid. Okay. Now the vacancy rate projection, this is one with CMHC where I disagreed with them at the start of COVID, and I was right. They were wrong. Most people were wrong about the pricing in our market. But vacancy rate projection, what I'm seeing is I'm seeing the millennial population and that kind of perfect home buying segment of our market. They are delaying home ownership right now because of affordability, because of complications in financing, because of the higher interest rates. So for me, I'm seeing renting for longer. I'm seeing renters be renters for longer. And these are qualified, phenomenal profiles: doctors, lawyers, accountants, high income earners, couples, even with kids now. Okay, we're seeing this translate to renting for a longer period of time. So for me personally, even with the addition of some rental market supply, I still have a hard time believing that we're going to see some vacancy in the rental market. I think the rental market will continue to be very strong well into 24, well into 25, maybe by 2026 when we see affordability, not affordability return, but affordability become a little more attractive with rates working their way down. Maybe we have more of a shift from renting to owning, but by 2026, the population growth is going to continue to be aggressive. And they talk about the reduction in international students. That's a drop in the bucket. That's like me taking my morning mug. You guys should have some Tyler McClay mugs. I take my Tyler McClay mug, I dip it in the ocean, and I say, holy smokes, the ocean levels are depleting. It is such an insignificant piece of the population growth pie, but it's being looked at a little more aggressively than it should. So, rental demand, I am firmly under the camp that the rental demand will continue to outpace supply. The difficulty in adding supply, even with the purpose-built rental supply that some of these bigger developers are getting into, and some of these, purpose-built rental condos are aiming to solve that issue, the supply issue in rental supply. We're just not there. Okay, we're seeing rents appreciate massively. So to put it in perspective, let's do some math. I just sold a 650 square foot pre-construction at Q Tower. You've heard about it. So we just sold that last night. 650, they're guaranteeing rent, or the anticipation is that rent will be $7 a square foot. $7 a square foot on that unit is $45.50, if I did my math right. So correct me if I'm wrong. But $45.50 at $7 a square foot. This one doesn't have a rent guarantee, but some of the other units at this project do. If you're anticipating the rent of a 2-bedroom unit to go from, right now we're in maybe just under 3,000, maybe hovering around the 3,000 mark. That's a 50% increase in rent. That's incredible. That's like owning a business and saying that my income, my business income, my gross income is going to improve by 50%. That's quite incredible. That's quite incredible. So for you investors, I will put myself in the crystal ball, tell you what I think is to come. Next rate announcement we know is July 24th. I can potentially see a rate cut. I am very confident we're going to have at least one more, and it's kind of mixed reviews on if we're going to see two more. I'd be kind of confident to see two more. I'm thinking we'll have two more to end the year. What does that mean? It means that the confidence is coming back to the market, the opportunity to lock something in at a very attractive price right now. The price of the assets are compressed because money is more expensive. You know my take on economic factors and whatnot. But the big thing for me is that the shift has started. So we're in recovery mode. If you wait too long, you're going to miss out on this first bit of gain. It won't be too late. It's like the boat is leaving the harbor and it's honked its horn or whatever they do. And it's just, they've thrown their lines back to shore and they're just about to take off, just ready to go. Engines are on. You can still walk up that platform. They're just about to raise the platform. You can walk on that platform. Now, in the next 6 to 12 months, it's not that you can't still board that ship. you're just going to have to hop on a kayak or a dinghy and get out to the harbor before the ship gets out into open seas. In the next 12 to 18 to 24 months, that ship's in open seas. Good luck finding it. You're going to give up that big gain that we can experience right now. So that's my take on the market. Tried to keep it short, but there's a lot of substance here. Make sure you read the subject of this email as well. So have a great day.